So we are one session is already behind us, was the TIFA session yesterday. If you didn't have a chance to attend it or to watch it, you can find the recording on YouTube. So one session is behind us, 4 sessions to go. Today we are doing macroeconomics, tomorrow statistics at 3 p.m. And then next Friday we have first hospitality economics at 12:30. And later in the afternoon, we have at 5:30 p.m. we have SQD. If you want to come to class, please find the details on our Instagram page, where you have to register before, and then you can actually come here and attend the session live. So today, as we said, this is macroeconomics session based on the course of Professor Davwan. It will be presented by Mr. Kim Oatley, our academic tutor, and by me, academic tutor as well. So some basic information. Today, we are not planning to do a very long session because the information, as you will see, is very concentrated. Everything is just really a recap. So we hope you have some knowledge that you already started preparing for the exam, because then it will be much easier to follow. However, if you won't be able to follow some formulas, details, you can always go back on YouTube, pause the video, and then when you understand it, just go ahead and watch it. So the recording of the session will be uploaded on YouTube by tomorrow morning, hopefully already today in the evening. So the recap of the course will take around 1 hour, and then we'll have some time to do Q&A. So as we said, this review is very focused on main concept that you will need to know for the exam. Basic knowledge of chapters is required to be able to follow. So this is the agenda for today. Before I give the word to Mr. Kim, so Mr. Kim will lead you through the first 4 chapters, and then I will take over. Just that I don't forget to also try to record. Oh, we're already recording. Okay. So then I will leave the stage to Mr. Kim.
Well, perfect. Thank you very much, Mai. Hello, everyone. Welcome to this macroeconomics recap session. As we said, we've tried to concentrate the most important information onto almost one slide. That was our challenge. And just maybe some information about the exam and also the recap that Professor Davwan did in class this Friday. With the exercises, it's really about understanding the equations, understanding the graphs, and then you can, first of all, you can solve all the equations basically and all the questions really easily, and you also understand the concept behind what the shift in different curves occurs and why it does. So let's start with the first chapter, Macroeconomic Concepts, which is the general GDP calculation or the GDP equation that you need to know, with always the same variables, so they don't change throughout the chapters. It's always the same, and if you have to know them, of course, also already for the midterm. So I'm just gonna be very quick here. GDP is which is equal to Y, and consumer plus investments plus exports plus government expenditures minus imports. That's basically the total consumption that you need to have, and that's not always changing. Actually, in a lot of for the midterm and for some simpler questions, you can actually use this equation, which is really handy. Comes in because you have all the sub-equations there as well. Then there is 2 different valuations of GDP, which is nominal GDP and real GDP. Make sure that you read those questions correctly on the exam as well, because there might be because of one word, you might miss some points if you don't do that, because nominal GDP is measured in current price and real GDP is measured in constant prices that are there. So just make sure about that. It's also for TIFA, then the same thing on Monday, I guess. The value-added method is the first one that you see. If you want to go back to chapter 1 onto the slides, because Professor Davwan's slides are already super good in our opinion. So he has the table where you really are calculating the value-added method for the GDP is calculating the intermediary values of all domestic producers. Really important is domestic producers. Foreign producers don't count here. It's intermediate values plus own production value, which that equals to the whole production value. And yeah, it's really all intermediary inputs. Then the income method, it sums up the income of received from domestic producers, salaries, loan interest, and profit. And that is then the second method. And the third one is the expenditure method, where you are looking at the expenses that the producers had, always domestic producers, which is really important to know. Then GNP is equal to GDP plus income earned by abroad citizens minus income earned by foreigners in the country. This is super important. I think that was on the midterm. That was one question where he also presented us with a table that he's shown us in class and asked for GNP other than GDP. And that was a different calculation, so different results. So really pay attention to that as well. It's a different result, and then yeah, also impact the final result. I think that's pretty clear. We can go to the next one. There's no questions. Also, by the way, guys, interrupt me anytime you have a question about the concept or anything, because maybe at the end it's a bit too far back. So anytime you like that. So we can go one slide further, and yeah, to the second chapter. Mai, can you quickly go one slide further, please? Mai? Hello? Ah, perfect. Thank you very much. Okay, so as I said, very concentrated. So this is what we've tried to do for the whole second chapter. We have one slide, almost 2 slides in total. But we are looking here at the IS curve and the goods market in total. And we're looking first, going from left to right, at the consumer. So Y is, as I said, Y is equal to the production and to the income, to the GDP. And then this goes to households. And households, they are earning something. And there is a thing that is being deducted. As we know, it's taxes that they can't influence at all. And then you have the net income, which is Y minus tax, right? So very simple in that regard. Then you have leisure consumption, which is beta times Y minus T. So out of the net income, there is a certain amount that is being spent on leisure consumption, which is what you spend on anything that is not necessary. And there is a subsistence consumption, which is constant, which is alpha. This is always constant. This is an alpha that every household, no matter what the circumstances, is spending for sure. And this should be given. And this then also goes in with savings, which is then going to be in chapter 4 that we're looking at this. And then in the end, you get the consumer side with the equation alpha, which is the normal consumption, plus beta times the net income of a household. And then if you multiply that out, you have alpha plus beta Y minus beta T. And that's basically the whole thing. And this is going to come back in the total consumption and demand. So now first investment, we have a maximum investment, which is equal to gamma, if I'm correct, yes, which is gamma. And then you have the interest rate, I, that we've been looking at as well. And then you have the epsilon, which is the sensitivity to I. So that means to the interest rate, actually. Because this is big I, is supposed to be a small I. So the sensitivity to the interest rate is basically how volatile or how much a company's or the company's investments depend on the change in interest rate. Okay, so the higher the number, of course, the larger the effect of on the interest rate is on companies. And there is never the 100%. Well, it can be 100%, but normally not really always 100% of the interest rate that affects the total investment of the firms. And then you have the government expenditures. We didn't look into it, what that is. Of course, we know what that is with the tax money. They are building streets and everything, schools and public services, basically. And then you have the total consumption, which in the end is Y equals Z equals consumption plus firms' investments plus government expenditures. And now we need this to build the IS curve that we're going to see in the next slide as well. Should be all very clear through here. What's being done for the IS curve here is with the consumers. You are basically putting together alpha minus beta T, which is equal to alpha bar. Don't be thrown off by that. This is also a sub-equation you can sometimes use if you don't know what alpha bar is, but you know alpha, for example, and you know beta, you know the tax. Use this equation and just keep in mind that this is a sub-equation you can use sometimes for calculations depending on what he's asking. So then here we go for the IS curve. We have y is equal to alpha bar, which is again alpha minus beta t, plus gamma minus y minus gamma I, minus epsilon I plus g bar. And this divided by 1 minus beta, and then this is equal to gamma bar minus epsilon bar times I. Same thing, which is basically the thing. Now you can actually do, what you can actually do here is, which gamma bar is basically part of the equation that you have for y, and then epsilon the other equation. So depending on what he's asking, again, use those sub-equations, play around, plug in the values. Normally it's all about plugging in the formulas, and then you can actually use them in in the question that's being asked. Yeah, basically that's kind of it. Yeah, it's just about restructuring the formulas to see that, and that's basically it. So what you have here in the goods market is just a different curve. The IS curve is basically downward sloping curve always, with interest rates, and then the output is dependent, of course, on the interest rate, right? So yeah, that's basically it. And the shift in the curve, or at different points in the curve, is the demand that is shifting for the different interest rate I. So if the demand curve Z is shifting, then this will also shift to a different point on the IS curve, as seeing that supply, of course, is being constant. Perfect. That's just one of the examples that we had. Now we go to chapter 3, which is the Keynesian model. Here we have same base as we had before for the IS curve. Here, what we are doing is we don't use alpha bar, but we just use C, the whole, and then I, and with epsilon again, and gamma, which are constant and given normally in these kind of exercises. So what is the Keynesian multiplier? It's a change in output gains minus a change in government expenditures. Pretty much, we only looked at this one. There's different classes and different courses where they have looked at different Keynesian multipliers. They're different, dependent on, of course, what's going on. So normally it's equals to the delta of y divided by the delta in taxes, and it's again only valid for changing government expenditures. This applies definitely for Professor Daman's course. He's not going to ask us any other Keynesian multiplier, just that one. And here also, what's that? How do you find a change? Basically, if you have the equations, and this is a tip that helped me well in the midterm as well, is basically you just assume a different value of any value that you need that you have at the output of the equation to get the delta, and then you calculate the delta because the equation stays the same. You assume a value. If you have, for example, output is 100, and then you assume output of 150, just given, and because of the equation should be the same delta always if there is not two values given. So just assume one, take the difference, and then it's very quick to calculate as well. It's the kind of the stupid way, and as I think of it, is to do it, which is but it's very efficient and should work quite well. Now, just looking at the stimulus during a recession. And this also kind of questions that professors like to ask in exams, like what follows after what. I've tried to demonstrate that here a little bit with the arrows. So governments can either decide to increase their expenditures, G bar, or do tax cuts. So those are two ways that a government can technically handle a recession, which of course is not what we want. So if you increase the government expenditures, you increase the demand. Well, why is that? Because you have higher demand on the total goods market because you're increasing then G bar, which then if you go back to the equation that we had before, right, is always Y plus C plus G bar plus I. So if you increase one of those factors, the whole GDP increases. It's not even about, it's not very abstract in the end. You can just go back to the basic basic chapter 1 equation, and you see that if you increase one, well, of course, everything else increases. So that's how it goes. Then this will then lead to an increase in output because there is more production, so you're producing more. Then this in turn, because you have more jobs, you have more production, this will increase household revenue. And if you have more revenue, of course, because alpha is constant, so the subsistence consumption is at the base, then you have more money left for either savings or leisure consumption, which then increases the consumption. And then this again will increase the demand, etc., and basically going forth and back like this. Now, if you do a tax cut, this will directly increase consumption because, of course, as we saw again in the consumption model from chapter 2 and with the arrows, it's basically if you reduce the amount of tea that's going away straight away, the net income is going to be higher, right? So this means you're consuming more because you have more disposable income. This will then go up in the demand. Will then, if the demand is higher, firms have to produce more, so higher output. Household revenue in the case will go up as well because higher output means more jobs, and then the consumption again increases and demand increases, etc. So this is the way of looking at it. It's really about looking at a household from a household perspective and what they want and what's then the conclusion, right? Because, for example, as I said, for higher output means, of course, that you need to have more workers, so they're producing more, so you have more jobs, and then this will also in turn then have a higher household revenue, which is kind of the thing. So for a negative multiplier, then the output only increases when taxes decrease. This is important because not all Keynesian multipliers are positive. So that's really also a theoretical question that he might ask you, or that you might be calculating a negative multiplier and then says there's the question, okay, what is government expenditures increase? Well, that's not really there's not really an increase in output. It's only when the taxes decrease for that. Perfect. And then we go to chapter 4. I think that's almost, yeah, here we go to the financial markets. So why do we need money? First of all, it's a way to transfer resources between persons across time through trades and markets. Very abstract thing. What we're looking at here is basically two different types of accounts. We have first checking account and then savings account. Checking account is an account that you have payment can access directly. This is when you have a debit card, for example, or any non-credit card thing. Then there's of course no interest payments on that because you're using the money straight away, and you can pay at any time. And the cool thing for the bank is that it's free for them as well, because the money is just there, it's being used, it's being brought back into the economy. Now for savings accounts, there is no payments. You can't do payments with the savings account per se. You have to transfer money from the savings account to the checking account to then make payments. The cool thing is here again, there's interest. Well, at the moment, not really, because again, Switzerland, zero interest or even negative interest. So that's also a thing, like saving account might not be the best option because sometimes you have to, in these situations at the moment in Switzerland, you have to pay money you have to pay the bank that you're keeping the money on your bank account, on the savings account, which is kind of a bizarre situation, but that's how it is at the moment. And you have to give a withdrawal notice, maximum amount over a period of time, which is basically the savings account is what the bank runs their business with, right? So they are using that money to make investments and to basically work with that. And that's why you also have to give a withdrawal notice to that, so that the bank knows that, okay, they don't have that money available anymore, because it's still yours, but they'll won't have it available anymore to do their operations with. And the cool thing is then, basically, because you're technically you're financing the bank's operations, you're earning interest, right? Because you're helping with business, and you're basically an investor, more or less, and you earn interest on this account normally. Then that's, again, as we said, good for the bank because it saves money on the reserves, and you can give out loans and so on to different stakeholders. Now, generally, a higher interest leads to a higher amount on the savings account and vice versa. So that's also a way to stimulate it, right? If the banks, they don't have enough money, they will increase the interest rate as well, or can try at least to get people to put more on their savings account and not checkings account. And this will then, if it's the other way around, of course, it will lower the demand for money if you decrease the interest rates. Now, increase in income means you have more on the checking account normally, unless the higher interest rates are offered by banks. So if you have the same amount of interest rates that you had before, if you earn more, you're going to leave more on a checking account, because why bother putting more on the savings account? It's not going to happen a lot anyways. Then lower checking account deposits, which then leads to lower money demand. That's what we said before. Higher money demand is when the output of the GDP, or the output which is equal to GDP, increases. Then you have a higher demand, unless again interest rates are rising for that. That's basically just the basis for the financial market. That's what generally applies, and the two different accounts that we are looking at in this specific situation. Now, then important, of course, to build the ISLM curve. Good. We can go to the next slide, I think. Perfect. So, what are the saving motivations that you have? So it's on income, to earn a good return on investment or capital income, which is saving on earnings. That's what you're doing on a daily basis in a more or less short to midterm sense and in a perspective. Then what you do for the future and for any longer period of times are precautions in case something bad happens. That's generally extra expenses. For example, if we don't have health insurance, sometimes it's the case. I think health insurance is pretty. It's not guaranteed and not mandatory in the US. I'm not sure. Correct me on that. So, for example, if it's much more expensive if you have an accident in certain countries because you're not that well insured. So you need to put money on the side in case something happens. Retirement, of course, as well. Same thing. You need to have something to put get through to your retirement. Here in Switzerland, we have a special system here as well, that you put in money away in 1, 2, or 3 pillars. It's a bit of a complex system. Then bequest and gifts, to leave something for children. So in case you die, and then you leave something for your next generation. Depends. That's of course then when you have enough money to do that. Good. Next one. We go. We have the financial markets, which now we have the LM curve parameters that we're looking at here. So we're looking again at the household income, and then this is then equal to the Y. This is the production. So what do we have? We have savings for future, which is basically what the percentage of the general income, household income saved by the consumer, which then goes to commercial bank saving account, and that's then done with. We're not looking at that at the moment because this is basically inactive money for the consumer. The rest is 1 minus P, and here what we have here is actually the difference. So 1 minus P is basically because you are subtracting the percentage on the Y that you've already put away, and it's just a mathematical term to express that in a sense. Then you have savings for earnings, which you also deduct, which is then also going into the commercial bank saving account. So the saving on earnings, as we said before, is a short midterm, which is then depending on the I, on the interest rate, and B, which is B is the sensitivity to I again, to the interest rate, which is for gamma would be, sorry, no, epsilon be for the, no, sorry, it's gamma or epsilon, sorry, I did add a bit of a thing with the notations. Well, anyways, what that's the same factor is for the firms is here for the consumer applies as well. And after that, everything that's been deducted so far is then the money demanded on the market. So this is what people need to use, which is then again 1 minus P times Y minus B times the interest rate. And you can then formulate that again, which if you go a bit around and look at it from a different perspective, you see that I, for example, is equal to 1 minus p times y divided by b. So you can play around with those equations as well. And then you have the different equations here, as we said. Perfect. Nothing, anything special here. Yeah, that's basically it. So again, demand is declining as we had in a normal economy, but money supply is constant, and this is important. That is a straight line because it's set by the central bank, and it doesn't vary because there's only one player in that, and there's only one entity that can decide the money supply. So that's why it's a straight line, the money supply curve, and not as we had in other economic models. Good. I think that's pretty much it. And then you have, of course, shifts. If bank increases the interest rates, there is no bank run and no shortage. That's really as a fraction of the interest rate, which is pretty okay. You basically increase the interest rate until a point where there is the equilibrium between money demand and money supply. Of course, that's then the baseline. And then if the output changes, which is GDP, then the interest rate has to increase as well to further stabilize the get to the equilibrium again, because the money demand again is money supply again is constant, but the money demand shifts up because you have higher GDP, which means higher income. So the money demand is higher in total. So you have to increase also the interest rates to get people to save more. Then if you have any monetary policy changes, which are made by the central bank, then you also basically are increasing interest rates as well. If you decrease money supply, for example, or increase or decrease interest rates if you increase the money supply. So it's really about shifting that curve as well. But this is very rare in that sense. I think, yeah, that's was it from almost from my side, I think. One more slide. I think we have exactly. So so if small I, which is the interest, is decreasing, then savings are going down and consumption is going up. So as we said here again, if the interest rate is going down, savings are going down as well, and the consumption is going up, which means the demand for money in the end is going to shift, which increases the risk of a bank run. So unless the money supply is increased, then there's going to be a bank run, which means there's more money demanded than there's actually would be good for the equilibrium. And that actually is then what we can transfer into the LM curve, which is the basically really the difference between money demanded and money supply. And this is the curve, the opposite slope, always positive slope of the IS curve that we've seen before. And that's what we're looking at right now with in chapter 5, the ISLM curve, the two curves combined.
So yeah, can you hear me? Yeah, oh, hope so. Just a second. Is the screen?
It's good.
It's good.
Yeah, I can see.
Because okay, it's good. So then I'll be presenting chapters 5, 6, and 7. So Kim already presented to you the IS curve and the LM curve. So IS curve was chapter 2, LM curve was chapter 4. And then now we'll just look at what happens when we put those two curves together. So good, then we should have the goods market equilibrium, right? So goods market equilibrium, we only have it for those combinations of interest rate and the GDP or output or production, whatever you want to call it, that levels lie on the intersection of LM and the IS curve. So that's the only time when you will have equilibrium, or so the global equilibrium. So first of all, we we'll just take a look at the IS curve. We can see what happens if we have a point below the IS curve. That means that we have a shortage in production market, or we have a surplus if it's on the right side. And in financial markets, it's actually the same situation. So it's if it's below, it's a shortage. Always, if it's above, it's the surplus. So that's the easiest way to remember it. Yep. Then what's the most important in this chapter, because probably all questions of this chapter 5 are based on some graph movements, calculations of the change in GDP or the interest rate. So we know the equation of the IS curve from chapter 2. We know the equation of the LM curve. So we can put these two equations together and express them either with GDP. So this is, be careful, this is the x-axis. So this is not the way that you are used to express an equation of a linear function. This one is the way that you're used to. So this is I, and I is, in our case, it's a y-axis. So that's the usual way. So if you want to basically imagine like easier the intercept and the other parameters, that's the way, that's the equation to take also for these two ones. So it's the best way always to imagine what, because for instance you can be asked for there was an increase, for instance, in the capital earning motive. So capital earning motive, that's an S. So what happened? So if there was an increase, that means that either the steepness of the curve, now it's higher, so the curve is steeper, or the steepness stayed the same, but the curve moved up. So how do you know what happened actually? Because this is now expressed with I, that means that we have a classical linear function. That means that we have to search for the other axis. The other axis is y, so it's GDP. That means that here we have a coefficient, right? So that means that this is the part which represents not this represents the slope, right? So this is the slope of the curve, and this is just the part which tells us how high or how low is the curve. So that means that if we have increase in the capital earning motive, the steepness will stay the same, but the curve will move up. That's how you go if you are asked to do some changes in different parameters. So what happens if we then take a look, for instance, for this example that I gave, the LM curve, we said the S increased. That means if the S increased, we have a move up, so the LM curve will move here. It means the interest rate will increase and the output will then decrease. Okay. Yeah, so to be able to work with those equations, you always have to remember this one's mu bar, gamma bar, and the other two parameters. This was the one that we did right now. So this is the capital earning motive. This actually, which will tell us how much earnings will go from the rest of the earnings. So this is P was already excluded at this point when we decide, according to capital earning motive, how much are we going to still put on our saving account, and then how much are we going to spend. So, but then at the end of the day, if you forget what any variable is means, or what is the abbreviation, you gave the table here, so you can always refer back to this table. We were looking, so S is, as you know, it's 1 divided by B. So we were looking at actually sensitivity to the interest rate, which is actually then determines our capital earning motive, because more than we are sensitive, less we are going to spend for if the interest rate changes. So if for instance, if B is 0, then the S is 0. If that means that if the interest rate is 0, we are still gonna put some money in the account. Then we will do the price variations. That's the more theoretical chapter. Um, First, the first part of this chapter, it's about the inflation. So we have this chapter is actually split in two parts. So we have price, we have the inflation part, and we have the exchange rate part, which is kind of even more important. So over the time, prices tend to increase. That's called inflation, even for the same good with no improvement in quality. So it's important to understand that inflation doesn't take any improvement in quality into consideration. The average economic condition of households deteriorate if their income grow at slower rate than inflation. So if their income grow at 1% and inflation is 2%, then each year they will be able to spend less, to afford less. Their Y will be lower, right? So if there is an increase in demand for their products, business might respond with price increase because they want to keep the same level. So we have two options here. If we combine the inflation or recession, so inflation is actually if we have an inflation, then the logical policy decision in order to keep it at the lowest level is to decrease the money supply, right? What will happen when we decrease the money supply? We will also have a lower demand, because when we decrease the money supply, we saw before, if I may refer back to the LM curve, that LM curve will then move to the left, and then we'll have lower aggregated demand, right? And then we'll also have a lower inflation because we'll spend less. I mean, the companies for investments, right, will spend less. And when we have a recession, that's an economic it's basically some years with really bad growth and result, then we can increase the money supply. Because what happens when we increase the money supply, the banks will decrease the interest rate, right? Because it will be, when there is more money, it's lower risk of bank run, so they can afford to decrease the interest rate. And when they decrease the interest rate, we have a movement on the IS curve as well, because then the firms will increase their investments, right? You still remember, I hope, that the investments are heavily impacted by the interest rate. So if the interest rate is low, the firms tend to invest more because the loans are cheaper for them. So, and then for the foreign market, foreign exchange market, it's basically this market functions. If you understand the law of demand and the law of supply, then you should easily understand the market, the foreign exchange rate. It's just the first thing that we want to get through is the notation, right? So we have an E and then the absolute value. So what does it mean? This means the direct quotation view. So the currency that is listed first, right? That's the one that determines how much are we going to get for one piece of the currency that's listed second. So in this case, if you want to buy or get, so in this case, it's a bit different than in real life, because in real life you have a different rates for buy or sell. But in this case, we take into consideration just the same rate. So if you want to buy €1, in this case, you will need 1.2 Swiss francs. So the other, vice versa, if you want to for €1, you will be able to buy 1.2 Swiss francs. And then, for instance, let's look at the first impact of buyers of foreign currency. So a demand side of a Swiss direct quote view. So if okay, let's start like Swiss households, they want to buy European imported goods, right? But because the currency is different, they can't just buy it using Swiss francs. So you always have some Europeans using euros who put their money in Swiss banks, right? So Swiss household, they deposit savings in Europe, and vice versa. The Europeans, they deposit money in Swiss banks. So that's how euros get to Switzerland. There are also some foreign households working in Switzerland. They send money home, so they want to change Swiss francs for euros. And then the other part is the supply curve, where you have European households, they want to buy Swiss goods, right? So these are the supply of euros, right? You have demand of euros, so that's how much euros do you want, and the supply is how much euros do you get. That's the foreigners who deposit their saving in Swiss banks. But you know, we saw in chapter 4 that deposits in a bank, they depend on the interest rate. So we have an exchange rate in equilibrium, right? So when demand for euro, there's demand one, the blue one, when the E increases, so when the exchange rate increases, when the demand increases, then euros are more expensive, right? And then that will mean that when euros are more expensive, Swiss residents, they will buy less imported goods and they will buy more Swiss goods, meaning what we will see in the next slide, as a consequence, Swiss GDP will increase because Swiss will buy more Swiss goods. And the supply of euros, it also increases as E increases, because then the Europeans, they can get more Swiss francs for the same amount of euros. So that's very attractive to them once again. Its exchange market equilibrium is only when supply meets demand curve at the intersection, and equilibrium defines the exchange rate E. And that's now the slides that I was talking about. We have the interest rate, let's say the constant interest rate. If on one side, if this interest rate increases, we'll have more foreign deposits, because as we saw once again for the LM curve, the higher the interest rate, more deposits we have. So we'll have higher supply of euros, but that means that the exchange rate will decrease. You will no longer get 1.2 Swiss francs for 1 euros, but you will get 1.1, for instance, because there is enough euros, there is more euros than we need. So that means that the supply is actually now higher, and that means that the E exchange rate will decrease. But that also means that that euros are less expensive, because a Swiss resident, before he used to pay 1.2 Swiss francs for 1 euros, but now he only has to pay 1.1. So European goods become more attractive and Swiss goods less attractive. And that also causes that Swiss GDP decreases. But on the other hand, when we have a decline in interest rate, there is exactly the opposite. So the foreigners, they take their money from Switzerland. We have lower supply of euros, and because we don't have enough euros now, the exchange rate increases. Now maybe the Swiss residents, they will have to pay 1.3 Swiss francs for each euros they buy. So the EU goods, they are very expensive for Swiss residents, right? So they will buy less, and therefore it will also increase the Swiss GDP. Now the last chapter of this semester is the AS-AD model. This basically, in this model we have AS, the aggregated supply curve. In case we have one firm, it is just the marginal cost of this firm, right? Because now we don't have the same scale anymore. Now we have price on the y-axis and quantity on the x-axis. Remember before, for the ISLM curve, we used to have output and the interest rate. So now we have a different y and x axis. So now fundamental question of aggregated supply is, if the price of goods is level P, so because we know that because of the the increasing costs, so marginal costs are increasing. So if we increase quantity, also the price will increase. So how many goods are firms willing to produce and sell at a certain price? So if the slope is always positive because marginal costs are always positive, certainly. But the question is, if we have more firms, what happens then? Then you have to calculate the marginal cost for each firm, express it in matters of quantity, and then you have to sum it. You must not sum it as a marginal, expressed as a marginal cost, because then you are summing a price, and you don't want to sum a price to get aggregated supply. You want to sum the quantity because that's your independent variable in this case. And then we have the aggregated demand curve, which is just nothing else than a total demand for goods. So the Z. This is the fundamental question: is for a certain price, how many goods are we willing to buy? So the price influences the behavior of consumers and investments, but not the governments. That's important to remember. So if I give the example from the lessons, the price will not influence the decision of the government on how many schools to build on or how many chairs to buy for the governmental building, right? So at the equilibrium, what firms are willing to supply, it should match the purchase, otherwise the graph won't work. And also in the equilibrium, we have no surplus, right? We don't have any surplus because the AS curve we can imagine as a perfect competition, right? And then also we have a monetary policy connection, as we already saw before with the inflation and recession. So banks will always adapt their interest rate to avoid the bank run. And when money supply increases, the price and the output will increase as well. In this case, that means that if nothing else happens, when the money supply increases, we will have more investments, right? Well, yeah, and so we will have higher output. So we will have to make a movement on a curve. Then the prices will become the goods will become more expensive, but the firms will be able to produce largest quantities, and that will lead to inflation, right? That will lead to uncontrolled rise of prices of the goods. So the central banks who regulate the money supply, so sometimes they have a conflict of interest. So if there is a recession only, they will increase the money supply, try to solve it. But in some cases, they will have recession and inflation at the same time. And it's just the objective, it's not just the question which objective comes first, but we have to choose one at the expense of the other. So if we have recession and inflation, we have to decide for one. So try to balance the supply to not have too high inflation or to not have too high recession. And that was actually everything that we prepared for today's session. So yes, now it's time for the Q&A. So do you have any questions? Anyone online? Anyone in class?
There's not a lot of people online, so I think it's good.
So anyone watching the recording on YouTube, you can always contact Kim, you can always contact me, or directly EHLRecap, and we will try to answer your questions as soon as possible. Otherwise, let me then conclude this session. We would like to thank you for your attention. Of course, we wish you good luck for the exam. We can now mark that we are already 2 sessions through, so we only have 3 to go. Any farewell words from Kim?
No, just thank you very much, everyone listening from home and on delay. Thank you very much for tuning in. And yeah, anytime, happy to answer questions as much as I can. And yeah, have a great exams, guys. Lots of success, and then enjoy your summer holidays. We'll see each other hopefully for the SQD recap, which is going to take place in a week.
Oh yes, just to remind everyone online at the moment, and more importantly, everyone watching later. So, statistics session tomorrow. I'll be presenting as academic tutor once again. Also, I'm doing the hospitality economics together with Cecilia. You already know her from the midterm presentation, and then we have our amazing Kim doing the service quality and design, which will be our last recap session. It's scheduled to take place next Friday at 5:30 p.m. So if there are no other questions, let me just conclude this session. Have an amazing weekend. I hope to see you as many as possible tomorrow at 3 p.m. online or in class, and that's it. Have a nice evening. Thank you and goodbye.
Bye, guys.